Hello, and welcome to the Baird Trust Equity Income Mid-Year 2024 Portfolio Recap. My name is John Watkins, and I'm a co-portfolio manager on the strategy. This first slide shows our performance track record. In the quarter, our portfolio declined 4.1% gross of fees and 4.4% net of all fees, compared to the 2.2% decline in the Russell 1000 value and the 4.3% increase in the S&P 500. Year to date, our portfolio increased 5.8% gross and 5.1% net, compared to the 6.6% increase in the Russell 1000 value and the 15.3% increase in the S&P 500. One notable item on this table is the wide divergence between the Russell 1000 value and the S&P 500, both in the quarter and the year-to-date periods, but also in the longer-term periods. This divergence has been driven by the strong performance of a handful of large technology companies, which make up a significant portion of the S&P 500 and are mostly excluded from the Russell 1000 value. Most of these companies pay little or no dividends, so they are typically not eligible for our equity income strategy. In terms of our underperformance versus the Russell 1000 value for all periods 3 years and shorter, the fact that we own no energy stocks is entirely responsible. Energy makes up 8% of the benchmark and has performed quite well over the past 3 years, so owning no energy companies has hurt our relative performance. We have discussed this many times before, but just as a refresher, we typically don't like capital-intensive, commodity-oriented businesses. Over the very long term, their businesses' results are dictated by the price of oil, natural gas, or other commodities, and we have no idea where those prices will be in 3, 5, or 10 years. For this reason, we have mostly avoided investing in the sector. Finally, because we invest with a long-term business owner mentality, our primary focus for this portfolio is to generate an attractive total return over very long periods of time rather than quarters or single years. We believe that in performance measurement, the longer the time period, the more informative the numbers. This next slide shows the individual companies that were our top and bottom contributors for the 1, 3, and 5-year time periods. Two important points here. First, over the shorter 1-year period, there's a wide dispersion of individual stock price performance, with our largest percentage gainer in Progressive up 58% and our largest percentage loser in UPS down 20%. As we often say, a company's stock price is much more volatile than its underlying intrinsic business value. In the short term, stock prices can move around wildly for reasons unrelated to fundamentals. Second, when looking at the longer-term 5-year contributors, the total returns of the top contributors are orders of magnitude larger than the quite small losses of the laggards. This is an important characteristic of successful long-term investing, and our equity income strategy has benefited greatly from this phenomenon. As a reminder, this portfolio has 3 objectives. Portfolio yield higher than the Russell 1000 value and the S&P 500. Portfolio dividend growth higher than the Russell 1000 value and the S&P 500. And finally, a total return over full market cycles better than the Russell 1000 value. So the last 2 slides address the total return objectives, but this slide addresses the 2 dividend objectives. On the left-hand side of this slide is a long list of the 17 portfolio holdings that increased their dividend payments in the first half of the year, with the 5 largest percentage increases highlighted. Additionally, there were a number of companies that announced upcoming dividend increases, with JPMorgan Chase announcing their 3rd dividend increase in the last 5 quarters, amounting to a 25% cumulative increase in the last 18 months. The table on the right shows the dividend characteristics of our equity income portfolio compared to our benchmark, the Russell 1000 value, as well as the S&P 500. As you can see in the table, as of June 30th, we are achieving these objectives over the long term. Our view is that the combination of yield and growth together over many years can be extremely powerful. Moving on, this slide shows our recent portfolio changes. We made one change in January. We exited our position in Truist as we lost confidence in the management's ability to effectively allocate capital for the long-term benefit of owners. With the proceeds, we added to our holdings in Wells Fargo and Comcast. We believe Wells Fargo has turned the corner in its turnaround efforts under CEO Charlie Scharf, and we believe that Comcast's business is facing temporary headwinds that will alleviate over time. We viewed both Wells Fargo and Comcast as trading at very attractive valuations at the time of this portfolio change. Finally, just a few big picture comments. As I said in the beginning, this year's market performance has been bifurcated, with the largest technology companies, also known as the Magnificent Seven, generating more than half of the S&P 500's return in the first half of the year. We are currently in a hype cycle centered around the promise of artificial intelligence. We don't know how long the current market dynamic will last. It could be nearing its end or last for several more years. But our aim is to remain focused on the long term and avoid getting too caught up in the moment. In fact, as more investor attention shifts towards AI-related companies, the relative attractiveness of other outstanding non-technology businesses improves. Ultimately, we will remain disciplined in our time-tested investment process by continuing to focus on finding investment opportunities that meet our critical criteria: business, management, price, and dividend. We believe this is the best way for us to achieve attractive long-term investment returns over the coming decades. That does it for our mid-year portfolio recap. Thanks so much for your time.